95% of people who try to invest never actually build real wealth. Not because they do not earn enough money, not because the market is rigged against them, not because they got unlucky, but because they make one specific mistake that quietly destroys their results before they even get started. And the worst part is, most of them never even realize they are making it. They keep doing the same thing over and over, wondering why their account never seems to grow the way they expected. Today I am going to show you exactly what that mistake is, why it is so dangerous, and most importantly, how to avoid it so you can be in the 5% that actually builds real, lasting wealth. Because here is the truth. Building wealth is not complicated, but it is easy to get wrong if nobody ever shows you what to watch out for. So let us get into it. Why most people fail at investing before they even start. Before I tell you the mistake, I want you to understand something important. The people who fail at investing are not stupid. They are not lazy. Many of them are hardworking, intelligent people who genuinely want to build a better financial future for themselves and their families. They read articles, they watch videos, they open investment accounts, they try. But trying without the right foundation is like building a house on sand. It looks fine at first, but the moment any pressure comes, it collapses. And in investing, pressure always comes. Markets go down. Life gets expensive. Emotions take over. And without the right foundation, everything falls apart. So what is this foundation that 95% of people are missing? It comes down to one word: patience. But not the kind of patience you are thinking of. Not just waiting around hoping things work out. I am talking about a very specific type of patience that completely changes how you invest, when you invest, and how long you stay invested. And most people get this completely wrong from day one. The mistake investing with a short-term mindset. Here is the number one investing mistake that keeps 95% of people broke. They treat long-term investing like a short-term game. They put money into the market expecting quick results. They check their account every single day. They panic when the value drops. They celebrate when it rises. And the moment things get uncomfortable, they sell. They take their money out at exactly the wrong time and then wonder why investing never seems to work for them. This short-term mindset is the silent killer of wealth, and it is not entirely your fault that you have it. Everything in modern society is designed to make you think short-term. Social media shows you people getting rich overnight. Financial news channels report on every daily market movement like it is a crisis or a celebration. Apps send you notifications every time your portfolio changes by 1%. The entire financial media industry profits from keeping you anxious, reactive, and focused on what is happening right now instead of what will happen over the next 20 or 30 years. But here's what the data actually shows. The stock market in any given single year can be extremely unpredictable. It can go up 30%. It can go down 30%. Nobody can reliably predict what it will do in any short period of time. Not professional fund managers, not Wall Street analysts, not anyone. But zoom out and look at the market over 10, 20, or 30 years and something remarkable happens. The pattern becomes incredibly clear. The market has gone up in every single 20-year period in its entire history. Every single one. Without exception. So the people who lose money in the stock market are almost always the ones who zoom in too close. They focus on days, weeks, and months instead of decades. And that short-term focus causes them to make emotional decisions that destroy their long-term results. The emotional cycle that destroys wealth. Let me walk you through exactly how this plays out because I guarantee you have either experienced this yourself or you know someone who has. It starts with excitement. Someone decides they want to start investing. They open an account, they put money in, the market goes up and they feel like a genius. They tell their friends, they put more money in, everything feels great. Then the market drops. Maybe it drops 10%, maybe 20%, and suddenly everything changes. The excitement turns to anxiety. They start checking their account multiple times a day. They read every negative news headline they can find. Their brain starts telling them that this is different, that this time the market is not going to recover, that they need to protect what they have left before it gets worse. So they sell. They take their money out, they lock in their losses, and move to cash where they feel safe. And then something painful happens. The market recovers. It always recovers. And now they are sitting on the sidelines in cash watching it go back up without them. They missed the recovery entirely. And now they are too scared to get back in because they do not want to go through that emotional roller coaster again. This cycle, excitement, panic, selling at the bottom, missing the recovery, is the exact pattern that keeps 95% of investors from ever building real wealth. And it is driven entirely by a short-term mindset that treats every market dip like a permanent disaster instead of a temporary and completely normal part of the investing process. What the 5% do differently. Now let me show you what the successful 5% actually do, because it is simpler than you think. It is not about being smarter. It is not about having access to better investments. It is not about timing the market perfectly. It is about doing a few specific things consistently and refusing to stop no matter what the market does in the short term. The first thing the 5% do is they invest automatically. They set up an automatic monthly contribution from their bank account to their investment account. The money moves before they even see it. Before they have a chance to think about whether the market is up or down, or whether this is a good time to invest, they remove emotion from the equation entirely by automating the process. This strategy is called dollar cost averaging, and it is one of the most powerful tools available to everyday investors. When the market is up, your automatic contribution buys fewer shares at higher prices. When the market is down, your automatic contribution buys more shares at lower prices. Over time, this averages out your cost per share and means you are always buying regardless of market conditions. You stop trying to time the market and instead focus on time in the market. The second thing the 5% do is they never check their accounts obsessively. Seriously, the most successful long-term investors check their investment accounts maybe once a month or even once a quarter. Not every day. Not every hour, because they understand that short-term fluctuations are completely irrelevant to their long-term results. The more you check your account, the more likely you are to make emotional decisions that hurt your returns. The third thing the 5% do is they keep their investments simple. They are not jumping between individual stocks trying to find the next big winner. They are not chasing the hottest new investment trend. They put their money into low-cost diversified index funds, specifically S&P 500 index funds, and they leave it there. Simple, boring, extraordinarily effective over time. The real numbers behind staying invested. Let me show you exactly how powerful patience is with real numbers, because this will make everything crystal clear. Research has shown consistently that missing just the best 10 trading days in the stock market over a 20-year period cuts your total returns roughly in half. Think about that. Out of approximately 5,000 trading days over 20 years, missing just 10 of the best ones, that is 0.2% of all trading days, cuts your wealth building potential in half. And here is the brutal truth about those best 10 days. They almost always happen right in the middle of the worst market downturns. The biggest recovery days happen right after the biggest crash days. Which means the investors who panic and sell during a crash, the 95% miss the exact days that generate the most wealth. And the investors who stay invested through the discomfort, the 5% capture all of those gains. A $10,000 investment in the S&P 500 held for 30 years at the historical average return of 10% per year grows to over $174,000. That same $10,000, if you missed just the 10 best days over those 30 years, would grow to roughly $79,000 instead. The difference between patient investing and emotional investing is almost $100,000 from the exact same starting amount. This is why patience is not just a nice quality to have as an investor. It is the single most important factor in determining whether you build real wealth or spend your life wondering why investing never seems to work for you. How to fix this starting today. Here is your action plan to make sure you are in the 5% and not the 95%. First, open an investment account if you do not already have one. A Roth IRA at Fidelity, Schwab, or Vanguard is the best starting point for most people. Second, choose a simple, low-cost S&P 500 index fund. Look for one with an expense ratio below 0.1%. Third, set up an automatic monthly contribution. Whatever amount you can afford consistently, even $50 or $100 a month. The amount matters less than the consistency. Fourth, delete the app from your phone or, at minimum, turn off all notifications. Check your account once a month maximum. Fifth, and most importantly, commit to a minimum of 10 years. Write it down. Tell someone. Make it a rule you do not break regardless of what the market does. That is it. 5 steps. No complicated strategies, no stock picking, no market timing. Just a simple, consistent system executed patiently over a long period of time. Final thoughts. The difference between the 95% who never build wealth and the 5% who do is not intelligence. It is not income. It is not access to secret investments or insider knowledge. It is mindset. Specifically, it is the ability to think long-term in a world that constantly pushes you to think short-term. The market will crash again. It always does. And when it does, every instinct you have will tell you to sell and protect yourself. That moment, that exact moment when everything feels most terrifying, is when the 5% stay invested and the 95% walk away. Decide today which group you want to be in. Set up your automatic investments. Keep them simple. Stay patient. And let time do what it has always done for every patient investor who ever trusted the process. Your wealth is not built in a day. It is built in the decisions you make and refuse to change over decades. Start today and never stop. Be for you. Go. Please like, comment, and subscribe to help the algorithm understand the channel.